What if I told you that one narrow waterway in the Middle East could move your Euro USD trade 200 pips in a single day? What if oil tankers stop moving? What if 20% of world oil supply suddenly gets trapped? What happens to US dollars? What happens to the euro? What happens to you as a trader? Today we are not discussing politics. We are breaking this down like professionals. No emotions, no bias, just capital flows. Let's talk about what really happens if Iran closes the Strait of Hormuz and how smart traders position around it. Why Hormuz matters? The Strait of Hormuz handles roughly 20% of global oil shipments. If it closes, oil supply drops instantly. Oil prices spike, energy markets panic, inflation expectations rise, risk sentiment collapses. Market don't wait for confirmation, they react to headlines. And market move fast. Now understand this. Forex is not about currencies. Forex is about capital flow. And capital flows towards safety when uncertainty increases. So what is safety? Safety historically is the US dollar. Now let's talk about why US dollar gets strong in crisis. You might think if oil spikes, won't the US economy suffer? Yes, but that's not the first reaction. The first reaction is fear, and fear creates dollar demand, treasury buying, equity sell-offs, emerging market weakness. The US dollar is the global reserve currency, the present currency for oil, the most liquid currency in the world. When oil spikes, countries must buy dollars to pay for oil. That alone increases demand for US dollar. Now combine that with investors selling stocks, fund reducing risk, margin calls forcing liquidation. Where does money go? The truth is, it goes into US dollar. So what happens to Euro US dollar pair? It drops, but that's only phase one. Now, let's talk about the shock move. This is the part most retail traders lose money. Let's imagine the breaking news: Iran closes Hormuz. Oil jumps $10 instantly. What happens on your chart? On Euro USD, 1 minute candle explodes, 5 minute structure breaks, spread widens, slippage increases, stops get haunted. Liquidity vanishes. This is not a strategy environment, this is a survivor environment. The market will sweep equal lows, trigger retail stops, create panic selling, or overextend, and retail traders will chase the red candles, enter late, get trapped in retracement. Smart money, they will wait, because after expansion comes retracement. Always. Let's look at how institutions actually trade this. Institutions don't trade the headline, they trade liquidity. Here's how they think. Phase 1, they create volatility. Phase 2, they harvest liquidity. And phase 3, they position strategically. So after the initial drop in Euro US dollar, you will likely see a retracement into imbalance, a move back towards broken structure, a liquidity grab above short-term highs. That is where repositioning begins. If the crisis looks prolonged, they will continue selling rallies. If it looks temporary, they will accumulate dollars early and rotate out once risk stabilizes. This is why patience matters. Looking at the incidence of the close of Hormuz from the oil layers or oil perspective, if Hormuz remains closed for weeks, oil remains elevated. Europe suffers more than the US. Why? Europe imports most of its energy. Energy equals higher inflation plus lower growth. That is stagflation risk. So now, Euro has two problems: risk aversion, economic vulnerability. That makes Euro structurally weaker relative to USD, which means even after retracements, the higher time frame buyers may stay bearish. Let's bring central banks into this. High oil will trigger inflation risk. And if inflation rises again in the US, the Federal Reserve may delay rate cuts. Higher rates equal stronger US dollar. But here is the twist. If oil spike triggers recession fears, eventually the Fed may pivot dovish. That is when the dollar can weaken. So timeline matters. Short term, US dollar is going to be bullish. Medium term will depend on inflation versus recession narratives. Long term depends on how long this disruption lasts. Trading scenarios. Let's structure this properly. Scenario A, short closure, that is for trading for few days. Oil spikes, markets panic, US dollar rallies, Euro US dollar drops, then diplomacy happens. Market stabilizes. Euro USD retraces upward. Then, trade approach to this kind of scenario is to look for exhaustion patterns after expansion. Fade extreme panics, move on structure shifts. Scenario B, prolonged closure. Oil remains high, Europe weakens economically, inflation remains elevated, risk sentiment is fragile. Buyers sell rallies in Euro US dollar, look for pullbacks into premium, daily imbalance, weak high forming, bearish structure continuation. Retail traders' mistakes during geopolitical events. Most traders lose during events like this because they over-leverage, trade defense impulse, ignore spreads, use tight stops in volatile markets, react emotionally. Professional traders reduce position size, trade higher time frame structure, wait for retracement, focus on capital preservation. The goal during crisis is not maximum profit, it is survival and calculated execution. Now let's look at the technical models. Let's visualize this on Euro US dollar. Step 1. Daily support breaks violently. Step 2. Liquidity strip below equal lows. Step 3. Retracement into 4-hour imbalance. Step 4. Lower high forms. Step 5. Continuation towards next daily demand. That is how structure behaves in macro-driven markets. You trade structure, not emotions. For Smart Rise TV Forex framework, here is the mindset shift. News creates volatility. Liquidity creates opportunity. You don't predict, you prepare scenarios. If Hormuz closes, ask yourself, where is liquidity resting? Where will panic occur? Where will institutions re-enter? Is the move extended or just beginning? This is how you think like a trader. In conclusion, if Iran closes the Strait of Hormuz, on short term, US dollar likely strengthen, Euro USD likely drops sharply. Medium term depends on duration and inflation impact. Long term depends on recession versus policy reaction. But here is the real lesson. Major political events don't destroy disciplined traders. They destroy emotional traders. Your edge is not prediction. Your edge is preparation. In volatile markets, reduce size, wait for structure, trade after liquidity grabs, follow higher time frame buyers, because the market doesn't reward speed, it rewards patience. If this breakdown helps you see the market differently, then you are thinking like a professional. On this channel, we don't gamble, we understand capital flow, we understand structure, we trade with clarity, and this is Smart Rise TV. Succeeding together.